A lot has happened since the last video where we discussed how the bond market and the dollar have both reacted to quantitative tightening and stocks would be next. I posted that video on January 29th, which ended up being fairly predictory as the market fell more than 11% since then. There was a lot of blame being thrown around as the mainstream media tried to find a reason for the market move, as they always do. However, most of the time they have no clue what actually moves the market. Among all the plausible reasons, one stands out as the most likely, this being risk parity funds. These funds spread risk evenly between different asset classes, generally uncorrelated assets. They mostly use stocks and bonds. This is based on the assumption that stocks and bonds are historically uncorrelated. However, looking at a chart of both stocks and bonds since the early 1970s, we see a strong correlation. Most of the reason why people think stocks and bonds are uncorrelated is the result of central bank policy, mostly quantitative easing. As stocks were falling during the financial crisis, the Fed bought the only thing it was allowed to, that being bonds. This huge injection of capital into the bond market propped it up and also allowed investors to front-run the Fed, knowing that bond prices would appreciate and they could sell it back to the Fed at a later date and a higher price. This strategy has worked well for the past several years, as the gains in the stock market have been more than enough to compensate for the losses in the bond market. However, that changed on February 2nd when bonds and stocks sold off hard together. It was actually the worst combined single-day sell-off since 2009 when you take into account the losses of each. Stocks and bonds selling off together are especially damaging to risk parity funds as they use a massive amount of leverage for the bond portion of their portfolio, as bonds are historically less volatile and therefore need to be a much larger size of the portfolio to generate the same amount of risk. As the market sold off, the problem was exacerbated as these funds scrambled to de-lever their portfolios. This obviously carried on to the beginning of the next week where the algos mostly took over and continued to push prices lower, all the way down to 25.80, where we rallied all the way back up to 27.20 before retesting the lows again, just under 25.30. We see price bounce off the 200-day moving average and rally almost 8%, putting in a high at 27.53. The S&P appears to be rolling over here as we tried to rally today, breaking the previous high on 216, but failed, causing the market to sell off sharply, closing at the lows of the day. Corrections like this generally retest the lows before breaking up to new highs, which will likely happen considering this price action. However, on the other hand, some investors may look at this differently. If we zoom out a little, the trend is still clearly up, and this does have the possibility of putting in a higher low. And if we look at the futures of the S&P, we see has already retested the lows and put in a higher low here. Bulls and bears will see this differently, but it's important to understand what each are looking at. I believe we'll be heading lower from here, and we'll look for support around the 26.20 level, and if it breaks that, of course, a retest of the lows at 25.29. I believe the markets are heading lower not only due to the bearish price action, but also what's happening in other markets. Taking a look at the dollar, we see it testing a critical level. It has bounced off key support around 88.60 and has started to rally. It's extremely important for the dollar to make a higher high here and break the previous highs at 90.56. If it fails to break these highs and rolls over, it will more than likely break support here and be headed a whole lot lower. When we take a farther look, we can see how important this level really is. Here are the 2009 and 2010 highs, which have created support here. But there's a lot of air between this level and the next level of support, likely around 84.50. If it does break this level, it will likely drop rapidly to the next level of support. We can see how quickly the dollar can fall after failed rallies here. The other concern are bonds, which continue to downtrend. We're getting very close to 2009 levels without any sign of stopping. And I don't think the bond market is going to be the safe haven everyone thinks it is when stocks begin to fall. Moving on to crude oil. As we discussed previously, the rally since June is a result of declining inventories, which started to decline in March and accelerated in June. We had 10 weeks in a row in draws up until the high. This had analysts calling for $100 oil within the next year. However, there are several significant headwinds which may prevent this from happening. Supply is now ramping up with shale producers coming back online due to the higher prices in oil. In fact, U.S. production is set to surpass that of Russia and Saudi Arabia this year, which should be a record-setting year for U.S. production. Obviously, higher prices will increase supply and therefore decrease demand. And it's also important to remember that a high supply from U.S. shale producers was a big part of the crash in crude oil prices in 2014. However, if we take a deeper look, we can see where a big part of the crude draws have likely come from. Unlike crude oil inventories, gasoline stocks have been rising sharply and are currently at the upper end of the 5-year range. In Q4 of last year, refineries hit a record 81.5 million barrels per day. This means that the refineries were drawing a huge amount of oil to make into gasoline, which ended up just sitting in storage. As gasoline stocks reach higher and higher levels, there will be less demand for crude from the refineries, which will eventually bring down price. We can see that crude easily blasted through support at 62.50 and fell all the way down to 58.07. It put in a higher high here and rallied all the way back up to 62.65, where previous support became resistance and caused crude to sell off. If crude fails to break back above this resistance level, it will most likely sell off and trade in this range between 55 and 62.50. Lastly, moving on to Bitcoin. After falling to just under 6,000, a mystery buyer bought $400 million worth of Bitcoin, which caused it to rally almost 100% back up to 11,747. However, it has just recently sold off sharply and is currently at 10,539 as I record this video. We can see that Bitcoin is reacting strongly to this downward sloping trend line, which has acted as resistance twice now. The 10,000 level has been critical in the past and will continue to be, as price must remain above it to continue the uptrend. If we break above this resistance, Bitcoin is likely heading higher, but if it fails once again, it's almost sure to break below 10,000 and retest the lows. There are some factors that have helped Bitcoin rally to the level it is today, but will likely come back to hurt the market. 20% of people who own Bitcoin bought on margin, meaning they borrowed money to buy Bitcoin. And this is most likely almost entirely retail investors, as institutions wouldn't go out on margin to buy Bitcoin. Retail investors were also late to the game, meaning they suffered the biggest losses. Many of the big players were in before the large run-up, and therefore still have a positive position. Now that many retail investors have negative positions or possibly even have been liquidated by their brokerage firm because of a margin call, they will likely try to get back in to make up the losses. One tool they might have used to get easily accessible credit would be through credit cards. However, banks see this risk a mile away and have banned Bitcoin purchases on all major credit cards. This should be a warning sign, as banks realize this risk and won't take it themselves. And this is where sketchy lending platforms come into play, like BitConnect, which offers outlandish returns that investors will never see. Basically, you give them your Bitcoin, they give you their made-up coin, you hold it in your wallet, and this is the interest they promise to pay. There's no chance you're making a consistent 10% a month through BitConnect. And this isn't the only one. There's other companies just like this, promising even greater returns, like 1% daily. A lot of the people getting into the market now are younger and most likely have never traded in financial markets before. But one thing they need to understand is how to separate emotions from reason when trading. All the cryptocurrency fanboys will show you their favorite crypto and tell you how it's so revolutionary and going to change the world, when they really should be taking an unbiased approach and closely watching price action, as that's all that matters. There's nothing fundamental about Bitcoin. There's no real value. There's no intrinsic value. It trades purely on behavior and news. And don't take this as me saying never buy Bitcoin. You should be. It's probably one of the best trading markets in a long time due to the volatility. You just shouldn't be buying it as a long-term investment with an unfallible belief that it will rise forever.